Hello, welcome to Rational Investing. My name is Cameron Stewart, CFA. Thank you very much for watching the channel. I greatly appreciate it. This week up, we're going to take a look at Cisco Systems. They make all the little router boxes that everyone's connecting to the internet, plus a host of other products and some services. Let's figure out how much cash money this stock makes. If we bought it today, held it for 10 years, how much can we make on our money? Ready? Let's get to work. Before we dive into the numbers for Cisco, I want to remind you what the 5 key attributes are for this channel here at Rational Investor. Number 1, top line revenue growth. Number 2, earnings growth. EBITDA's got to be growing. Number 3, strong free cash flow. Number 4, low debt. Number 5, well priced. What is a well-priced stock? We want a stock with a conservative forecast that over the next 10 years is expected to beat the market on an IRR basis. That's what we think of it as a well-priced stock, and it's kind of the foundation for how we build our analysis after it meets these criteria. Ready? Let's dive right into it. Okay, Cisco Systems, let's take a look. Their fiscal year ends July 31st, so this filming is of June 2022. July, they're in their last month of a fiscal year, so we expect 3 months from now their new 10K, their new annual report will come out. So what I've done is I'm pulling through 2021, which is last year's data. I'm using the current 3 months of actuals that I have to kind of project out for what the 2022 numbers are going to look like. But let's keep rolling forward. These are in dollars, in millions. Revenue 2013, 48 million. 47 million, 49, 49, 48, 49, 50, 50. Kind of very, very similar. They're going to post a pretty nice number, up about 8% for the year is my estimate next year based on kind of COVID bounce, some infrastructure upgrades, price increases, and so forth. So 2022 is looking rosy, but actually for the last decade, they have done almost zero in revenue. Very, very weak growth, which is not something we typically would like to see. EBITDA growth. EBITDA has been 1% over this period of time. Remember, EBITDA is enterprise level earnings before interest, tax, depreciation, and amortization. It's our enterprise level earnings that we like to see. Kind of a proxy for cash flow. Not a great one, but a proxy for cash flow. $13.6 billion, 11, 13, kind of 14, 16, and then out here, I'm anticipating about a $16 billion number for them. That's relatively flat, weak growth, but it is what it is. You know, they're kind of very, very slow, defined by a very tight range over these last 9 years. Don't really do a whole lot. Let's figure out what that looks like in enterprise value. Okay, to get enterprise value, the first thing we're going to do is we're going to find out how much debt they have. So I look at short-term and long-term debt, basically a little flat, declined a little bit. And in fact, the last couple years, if you look at this, they have cut that number down by $13 billion in two years. That's an incredible amount of cash flow they must have to buy down debt like that. And oh, look, they've got a lot of jack on the balance sheet. This is fantastic. $48 billion of excess cash down to 15. That's not great. We don't like to see this, but unless they're buying back shares or making use for that cash, then I'm fine with it. But that's a lot of cash on hand. I like that. That means they must be making positive free cash flow if it's piling up on the balance sheet. Even if it's coming down, it looks like they're using that cash to buy down debt. Market cap is shares outstanding times average price, $137 billion. Market cap to $233 billion in market cap. Actually, market cap is up. You'll notice market cap is growing, which is interesting over the last couple years. It's also some of the debt they've paid off has gone into market cap, but that's curious. Enterprise value, debt minus cash plus market cap, enterprise value. What is enterprise value? It is the entire business. Think of a house that you're going to buy. You're going to buy at market price the house. That's the enterprise value of the house. You're going to go to the bank. You're going to borrow money. You're going to come up with your cash down payment. And those two together become the value of the business. Same thing here. You've got the debt, which is the mortgage. You got market cap, which is the equity in the house. And you have the total value, which is the market price of a house. In the businesses, they call it the enterprise value. So that's what we want to look at. What is the enterprise value of this business? The neat thing here is when we look at our debt metric, right, metric for risk of bankruptcy, it's zero across the board. Small blip there, but zeros. Why? Because when I net debt with cash, subtract these two, it's essentially zero. That's fantastic. That means they have a ton of cash. We love to see that. Enterprise value to EBITDA is a ratio, kind of like a payback period. How many years of operating profit does the business have to generate to essentially buy itself? it's a nice way to judge how quickly you as an investor might get your money back out of that investment. And this range is pretty low. 8 times here is a cheap business, in my opinion, certainly for the size of this business. 15x might be a little rich for something that's not growing, kind of a sign of the times. But this is certainly simply very cheap. Long-term 11 times enterprise value EBITDA has been their historical average. Let's take a look at cash flow. Okay, so cash flow from operations, this is actually adjusted cash flow. I've adjusted it for the stock-based compensation that they add back to the cash flow statement. So this is adjusted cash flow, even though it says cash flow from operations. Adjusted cash flow from operations. But it's growing at 2%, which is what we want, right? That's one of the hallmarks. You want to see cash flow growing as a rational, prudent investor. That is 11 billion to 13 billion. Very weak growth, but growth nonetheless. CAPEX is the money that they reinvest in the business every single year. And what I like about this is it, decreasing. Well, I don't like that. That means they're probably skimping on something. That number should be much higher, frankly. So they're probably skimping on something to boost cash flow. But what I like, back to my earlier point, what I like is the delta between these two. They made $13.7 billion of adjusted cash flow from operations. The money that they generate, the cash, not profit, cash money that they generated for running their business for 12 months. They peeled off $700 million, and what's left is this, basically $13 billion. Now they have no net debt. They made a payment of $3 billion in debt, which means free cash flow to equity is $10 billion. But in reality, they didn't have to make this payment. They have plenty of cash on the balance sheet. So what it really is it's $13 billion is what this number should be. So their cash flow is very, very strong. When I look at shares outstanding are coming down 3% annually on average, which is great. That means you don't have to put any money back in the business and your ownership stake grows. It's a very nice thing. And they're using their free cash to buy back the stock. I like to see that. Free cash flow per share is just based on a per share basis here, and then a yield. Yield has raised a high of 10% when they were super cheap, and now it's come down dramatically as the price came up during this whole pandemic. But the trick is, what happens now if we bought the stock? All right, let's go ahead and forecast this business and figure out what it's worth. Here's our forecast. Before I dive into it, I want to remind you that I do teach a course on financial education. I can teach you to be an analyst. I will give you this Excel template. I'll give you 10 years of Apple 10Ks, and we will walk through how to value Apple together. And you can practice learning how to build a portfolio based on fundamental analysis for yourself. Check out the link down below, cashflowinvestingpro.com. Okay, back after the shameless plug to EBITDA, $16 billion is the forecast. Now I'm building that off of the 3 quarters of data that I have and guessing at the fourth quarter. For them, $16 billion, that's a 9% jump over year over year. But I think that's short-lived, right? We're going to revert back to the average. I'm giving it 2%, which is what cash flow grew at. I'm just going to run that out to see what happens. That puts them out long-term as a guess. A dart on the wall, who knows what's going to happen? It's a dart on the wall, $19 billion. I'm giving that a 10.4 times handle enterprise value EBITDA because it's a low, slow-growing business. It does not deserve a really high multiple. So this multiple is actually a little less than historical average of 11. That gives me just shy of $200 billion enterprise value, net some debt plus some cash. Divide that by the shares outstanding, I get a $48 price target out 10 years for this business. Now, if we take a look at the free cash flow per share, it's essentially the same thing, but I've removed that debt payment that they did not have to make. So I took $13 billion of free cash flow divided by the shares and grew it at 9% year over year, which is my estimate for their growth. Carried that forward 2%, which is the historical average, and applied a 6.7% free cash flow yield, which is kind of like the average they've had historically. That gives me just shy of $60 per share for Cisco Systems out long-term 10 years. Okay, now we have 2 valuation methods, right? We've got the free cash flow and the enterprise value. $60 and $48. It's a $53 stock out 10 years from now. Well, I can buy all the stock I want at $43 right now in the market. So $43, I get about a $10 capital appreciation on the stock over 10 years, which is not very big. If I drop this into an IR presentation, what do I get? Well, I've bought into a business that's going to produce a stream of cash flow that I own a pro rata share. That's what this is. This isn't a dividend. This is your representative ownership of the cash flow that you're buying into. You bought this cash flow for $43. You're going to sell it out 10 years at 53. That's going to give you a 12% IRR on this calculation. Remember, IRR is not an average return. It's a time-weighted return that takes into account this stream of cash flow along with this capital appreciation. It's how investment banks, it's how money managers, it's how everyone revolves around IRR. So that's why we use it here. But 12% is a decent return for a stock that really doesn't grow much. It's kind of a low and slow growth company. Growth in air quotes, it might not even grow. So I think it's a very interesting opportunity, especially if the stock continues to fall, because I think it is an infrastructure play. It is very ubiquitous, if that's the right word to use, across the platforms. It's globally diverse. 50% of their sales are in the U.S., something like that. So that it's a big behemoth that grows slowly, and if you can buy it at a low enough price, you can really lock in some pretty decent gains for a long term with very little uncertainty around the future. You don't need to bank on the growth rate, which is especially concerning given where we are in this economy, what the Fed might do. Who knows what's going to happen in the future? So risking your portfolio on a growth curve has extra risk embedded in it, and you can dial that back by waiting for the market to decline and picking up low, slow companies that produce cash flow on the cheap. Let's take a look at the distribution curve. If you're looking at this review a few months from now, you want to see what it looks like. $43, the current price at 12%. If this falls below $40, I think it gets really attractive. If it goes up, I would pass. So what I'm going to do is I'm going to give it a good, because it is technically above the 10% threshold that we want to see, but I would still wait to see if it comes down a little bit more. All right, let's review the 5 key factors that we use here at the channel. Number 1, top line revenue growth. I'm going to check the box, but barely. And this recent year, it does check the box. EBITDA is growing. Free cash flow is strong. Low debt, none. And well priced, yes, I think it's well priced because it's going to beat the market, at least estimated to beat the market. So I do like that. What I want to do now is just go over quickly the cash flow course and the club, the cash flow club. If you're interested in seeing one-pagers that I generate here, where it gives you 10 years of historical financial information, I build a cash flow and valuation summary, as well as an IR, and I summarize the 5 key factors right here for you. And I release a whole lot more stocks, about 10 to 12 a month, that I can't review here on the channel. Well, we're kicking them out. We've got analysts who are joining the club, issuing more reports, and these are custom reports that you can download if you join the Cash Flow Club. Check out my website, cashflowinvestingpro.com, where I teach a course to give you the tools you need to be a financial analyst and to show you how to build a portfolio of value-based, cash-flowing stocks that you can pick for your own future. Don't rely on the market data out in the world. Everyone's using the same screening tools. It's kind of all the same. They're just churning it over to sell you something. Learn to be an analyst. Read the 10Ks annually. Do your own conclusion. Build your own forecast. And put your money to work for yourself. Check out the link down below for both a free one-pager and joining the Cash Flow Club. All right, up next is going to come a couple videos of other value stocks that I've reviewed. Please check those out. If you like the channel, give me a thumbs up and a subscribe. I really appreciate it. Otherwise, I'll see you next week. Thank you very much. Bye-bye.